I want you to picture a specific moment. It's mid-2019. You're ambitious. You've decided to really get into trading.
Not just the fun stuff, not just the Reddit tips.
Exactly. You've done the work.
Yeah.
2 full years studying technical analysis, reading the books, watching the videos. You can spot a head and shoulders pattern like it's your own reflection.
Which is the dangerous part, isn't it? That feeling of competence.
It is. So you fund your account. $20,000.
Wow, that's real money.
That's real savings. And you go into the market feeling confident. You think there's a code and you've cracked it.
Oh, I think I know where this story's going. And it's not good.
It's not. 3 weeks later, 63% of that capital is gone. Just vaporized. Nearly $13,000.
Ouch. That is a gut punch.
And it's not even the money that's the worst part. It's the why. This trader, who's actually the author of our source material today, he wasn't being reckless. He was following all the rules from the textbooks.
And that's the classic heartbreaking story, isn't it? You realize that those intro to trading books might actually be the instruction manual for how to lose your money.
What a terrifying thought. So, welcome to the deep dive. Today we are unpacking a text called Mastering the Markets, a professional trader's guide to building sustainable edge.
Right, and I know what you're thinking. Another how to trade guide.
But this one feels different.
It is different. I read it less as a how-to and more as, I don't know, a survival guide for a war zone. It's about shifting your entire mindset from, let's call it retail gambling, to institutional engineering.
Institutional engineering, I like that. It sounds way more solid than guessing where the pretty line goes.
It implies mechanics, physics even. We're going to talk about the market's invisible engine liquidity and the really brutal math that makes it so hard to recover from a big loss.
And maybe the toughest part, why our own brains are often our worst enemy. But let's start there, at the crime scene. Sir Margin, the author, he knew his chart patterns. Why did he lose so much so fast?
Well, that's the first big pill to swallow. He thought the market was a machine.
Like a linear system. You put $1 in, a soda comes out.
Exactly. Good earnings report means the stock goes up. Input A leads to output B. But the source argues the market is not a machine at all. It's a CAS.
TS.
A complex adaptive system.
Okay, what does that mean in plain English?
Think less like a car engine and more like a rainforest.
An ecosystem.
An ecosystem. You've got high-frequency trading bots, giant pension funds, central banks, and, some guy on his phone on the subway, all with different goals, different timelines.
And they're all adapting to each other.
Constantly. This brings up a fantastic concept from evolutionary biology the text mentions. It's called the Red Queen principle.
Oh, from Alice in Wonderland.
That's the one.
Right.
The Red Queen says it takes all the running you can do to keep in the same place.
I feel that on a personal level.
Well, in trading, it explains something called alpha decay. Let's say you find a little trick, an edge. Every day at 10 a.m., a certain stock dips and then rallies. You trade it, you make money.
But someone's watching me make money.
I see it, so I code a bot to do it. Then a hedge fund sees us doing it, and they start buying at 9:59 a.m. to get ahead of us.
And just like that, the 10 a.m. dip is gone.
The edge is gone, it's been arbitraged away, the ecosystem adapted. So if your strategy is based on a rigid rule from a book written 5 years ago, you're fighting a losing battle. The Red Queen has already moved on.
So the goal isn't finding one perfect strategy.
No. The goal is building a system for learning, a meta strategy. You have to accept that what works today probably won't work 6 months from now.
Okay, so the market is a living thing that fights back. That's the big picture. But let's get into the physics, the mechanics, because this is where the text explains how the big players, the whales, actually operate. And it all comes down to one word: liquidity.
This is it. This is the engine room. If you've ever wondered why your stop loss gets hit just before the price turns around, you need to understand the limit order book, the LOB.
That's just the list of who wants to buy and sell at certain prices, right?
Yeah. Think of it like a reservoir of water. The resting orders, people saying, I'll buy if it drops to X or I'll sell if it hits Y, they are the makers. They provide the liquidity. They fill the reservoir.
And the takers.
They're the ones who just want to drink right now. They use market orders. They dive in and consume that liquidity.
Okay, that seems straightforward enough.
It is, until you introduce the problem of scale. See, if you or I want to buy a few shares of a stock, we're like a little bug on the surface of that reservoir. We don't make a splash.
But if you're a whale...
Imagine you're a pension fund and you need to buy $500 million worth of Apple.
You can't just click buy.
If you did, you'd drain the reservoir. You'd chew through every single sell order, driving the price up against yourself with every share you bought. Your average price would be terrible.
So you've got this huge problem. You have a mountain of cash, and you need a mountain of sellers to show up at the same time.
Precisely. You need a big pool of liquidity, a place where thousands of people have all decided to sell at once. Now, put on your predator hat. Where can you find a giant, predictable cluster of sell orders?
Oh,
Where does every single textbook tell every retail trader to put their stop loss?
just below the recent low. Just below that support level.
Exactly. So you have this huge bucket of sell orders just sitting there. Remember, a stop loss on a buy position is a sell order.
It's pool of liquidity just waiting.
It's a trap, but not for you. The institutions see this on their maps. So what do? They aggressively sell, pushing the price down right into that cluster of stops.
That sounds like straight up manipulation. It feels rigged.
It feels personal, but it's just physics. They're not trying to hurt you specifically. They're just trying to fill their order. They need sellers, and your stop is an offer to sell, so they trigger it.
And then everyone panics.
Mass panic. People see the support level break, and they sell. Or worse, they try to short the breakdown.
And the institution is just waiting there with a giant bucket.
A giant bucket. They're absorbing all of that forced selling, filling their huge order at a great price. And once their bag is full, what happens? All the selling pressure is gone because the retail traders are all out and the price just rockets back up.
That's the V-shaped bottom you always see on charts. The long wick.
That wick is the crime scene. That's the liquidity grab.
The book uses a really clear example of this with the NASDAQ 100 futures, right?
Yeah, October 26, 2023. It's a textbook case. The market was drifting down to a key support level, 14,140. Everyone could see it.
So all the stops were just sitting right below there.
Piled up. So the price accelerates down, smashes through 14,140, triggers the stops, flushes everyone out, and then boom! Massive institutional buying comes in, and the price rallies all the way to 15,000 over the next few sessions.
So if your stop got hit, you weren't just wrong, you were the fuel.
You are the liquidity. And the text mentions another trick they use here, iceberg orders.
Right, which is just as sneaky as it sounds.
It is. If an institution wants to buy 50,000 contracts, they can't show that on the order book. So the algorithm only shows a tiny piece, say 10 contracts, the tip of the iceberg.
So it looks like a small buyer.
You sell into it, and instantly another 10 contracts appear. Then another, and another. The huge underwater portion just keeps refilling the tip. They can absorb a massive amount of selling without tipping their hand.
So the market is basically a jungle where the big animals are camouflaged and hunting the small ones.
That's a pretty good way to put it.
Okay. So let's say I get it. I start thinking about liquidity. I stop putting my stops in the most obvious places. I still have to survive the math. The source calls this the ruins problem.
And this is where we move from offense to defense. Honestly, defense is everything. The ruins problem is just the simple, brutal math that a loss hurts you more than an equivalent gain helps you.
I think we all feel that intuitively, but the actual numbers are kind of shocking.
They're terrifying. A 10% loss needs an 11% gain to break even. Manageable. But what if you take a 50% loss on your account?
Okay, so I've got half my money left. To get back to where I started, I have to double it.
You need a 100% gain just to get back to zero.
Ouch.
And it gets worse. If you have a 90% loss, which happens to people who say, I don't use stop losses, you need a 9,000% gain to recover.
9,000%. That's impossible. That's game over.
That is ruin. That's why the author says the number one job of a trader isn't making money. It is aggressively defending capital. You are a risk manager first and a speculator second.
So how do you do that? The book talks about position sizing, specifically volatility-adjusted sizing.
This is so important. Most retail traders just bet the same amount on everything. $1,000 on a blue chip stock, $1,000 on some wild crypto coin.
Seems fair, right? Equal bets.
But it's not equal risk. That crypto coin swings 20% in a day. The stock moves maybe 1%. That crypto bet can blow a hole in your account.
So you have to size your position based on how wild the asset is.
Exactly. You adjust for volatility. If something is super volatile, you trade a smaller position. If it's stable, you can trade a larger one. The goal is to make a bad day in the crazy asset hurt your account same dollar amount as a bad day in the stable one.
You're equalizing the risk across the board.
You're fireproofing your portfolio. You're removing the luck factor from your risk.
Okay, so we've got the ecosystem, the red queen. We've got the mechanics, liquidity. And we've got the math, the ruins problem. If I master all that, am I good to go?
You'd think so. But there's a final boss, and it's the person looking on the screen.
It's us. Our own brains.
Our own biology. I mean, the technical stuff is easy. Learning chart patterns is a weekend project. Learning to control your own emotions is a lifelong battle.
The fight between the amygdala and the prefrontal cortex.
The lizard brain versus the logic brain. And it's not a metaphor. Under stress, like watching your account balance drop, your amygdala, the fear center, literally hijacks your brain. It reduces blood flow to your logical prefrontal cortex.
So when they say fear makes you stupid,
Yeah.
it's literally true.
It is physiological. You are biologically less capable of making a rational decision.
And that leads to all those biases. Loss aversion is a huge one.
Oh, loss aversion is so powerful. Studies show the pain of a loss is about 2 to 2.5 times stronger than the pleasure of an equal gain.
So losing $100 hurts twice as much as finding $100 feels good.
Right. And that completely messes up your trading. You're in a losing trade. It's painful. Your brain screams, don't sell. If you sell, the pain is real. So you hold on, hoping it comes back. You let your losers run.
And with a winning trade.
You get anxious. You want to lock in that small, good feeling. So you sell way too early. You cut your winners short. It's the exact opposite of what you need to do to be profitable.
The book gives a really practical tool for this, though, the HALT protocol.
Yeah, and it sounds simple, but it's critical. It's a pre-flight checklist. Before you trade, ask, am I hungry, angry, lonely, or tired?
I think I am at least one of those at any given moment.
Then you shouldn't be trading. The science behind this is heart rate variability, or HRV. If you're tired or stressed or hangry, your HRV drops. Your biological system is already compromised. You are primed to make bad, fear-based decisions.
So the professional advice is literally go eat a sandwich.
Or take a nap. Mastering the markets is often just mastering your own biology.
It's amazing how it all comes back to discipline, not genius. Okay, let's bring it home. The text outlines the 5 stages of trader development. I think this is a good roadmap for people to figure out where they are on the journey.
It starts with stage 1, unconscious incompetence. That's the gambler. You don't know what you don't know. You win a few trades, you think you're a genius. When you lose, it's because the market is rigged.
Then comes stage 2, the wake-up call.
Conscious incompetence. The student. This is the valley of despair. You realize how much you have to learn. You get overwhelmed. It's analysis paralysis. You're working so hard, but you're still losing money.
And this is where most people quit.
Absolutely. But if you push through, you hit stage 3, the aha moment. You realize it's not about finding the perfect indicator. It's about risk management and psychology.
Then stage 4, conscious competence, the grind.
The grind. You're profitable now, but it takes all your focus. You have to force yourself to follow your plan every single day. It's not effortless, but it works.
Until, finally, stage 5, unconscious competence.
The master. It's flow state. You just execute. There's no emotion, no hesitation. It's like driving a car. You don't think about it anymore. You just do it.
And the book says getting there requires a really strict habit, the trading journal, and not just writing down your feelings.
No, it's a data log, a feedback loop. You track metrics. A key one he mentions is MAE, maximum adverse excursion.
Sounds complicated.
It just means, after I entered the trade, how far did it go against me before it turned a profit?
Why does that matter if the trade worked out?
Because it shows you if you were good or just lucky. If your MAE was bigger than your stop loss, you should have been stopped out. You survived by pure chance. The journal gives you the cold, hard data your ego wants to ignore.
It removes the ego from the equation.
That's the whole game.
So to pull it all together, the market is this living, breathing battleground for liquidity. The math is designed to knock you out if you're not careful. And your own brain is hardwired to make you do the wrong thing at the worst possible time.
It sounds kind of bleak when you put it like that.
It does. But the other side of it is that if you understand these things, the structure, the math, the psychology, you can start to navigate it. You can build that institutional edge for yourself.
That's the real message. Stop looking for a crystal ball and start acting like an engineer. The author's final point is that the market is the ultimate mirror. It just reflects your own discipline, or lack thereof, right back at you.
That's a heavy thought. It's about character as much as it is about charts.
It really is.
So, as we wrap up this deep dive into mastering the markets, I want to leave you with a question that comes from that Red Queen principle. If the market is always evolving to beat yesterday's strategy, are you building a rigid set of rules? Or are you building a system for learning? Because only one of those survives in the long run.
Well said.
Thanks for listening to The Deep Dive. We'll see you next time.